There's definitely challenging environment present. I wouldn't liken it, however, to the weeks after Lehman for good reason. I think, first of all, it fell a lot more after those weeks, far beyond that into the next year. But in addition to that, at that point, no one recognized the illiquidity discount that was necessary for purposes of high-yield bonds. And frankly, at that point, the regulatory regime that we have now that was created in the wake of 2008 wasn't present. So we've got banks now that are out of that game. They no longer hold inventory. They no longer facilitate trading. They no longer provide liquidity to the market. And so therefore now we have to price in a much higher illiquidity premium. We're now starting to do such a thing. The second thing that's very important is we have a serious contagion going on with respect to energy and mining. And that's a good portion, not a gigantic portion, but a very sizable portion of the overall high yield market. So if you've got fund managers out there that are holding toxic oil and gas and mining bonds that they can't possibly sell because there's total illiquidity, and they're looking to go ahead and raise some capital for whatever reasons they need to, they have to go ahead and sell some other things in their portfolio, and they're finding out that those things aren't necessarily so easy to sell as well.
So then is the weakness recently in the high yield market telling us nothing much more than the fact that energy and commodities have been such bad places to be? In other words, is the credit cycle in general not turning? Do we not have to be concerned about any messages that the credit markets are sending about the economic prospects?
I don't think so necessarily. I think the economy's been kind of steady as she goes for a while now and continue to be steady as she goes for a while coming. The next real concern for the credit markets in terms of fundamentals is a maturity wall that, frankly, the world's been talking about for a decade now. It's now pushed out to like 2018, 2019, 2020. That's when the issues will begin to go ahead and creep up, unless some issuers run out of liquidity before then and they frankly cannot any longer support the debt load that they have, a la a lot of specialty retail companies.
Well, that's the argument, I guess, is that defaults surge typically ahead of a maturity wall if, in fact, you stop being able to refinance, right? So if, as an investor, a potential investor in this area, are they attractively priced right now in general or in pockets to the point where you'd be able to take that headline risk of defaults and everything?
I think the most enticing area are triple Cs. That are not in energy or mining, because I do think that there could be a considerable rebound. They're trading down very hard on the basis of illiquidity. A lot of folks trying to raise cash before the end of the year, and so therefore there is opportunity there. So that's where we're focused right now.